What's up, everybody? Michael Silva here. Hope you had a good weekend. It's Monday, and there's been a pullback in some big names, as you can see here, looking at the S&P 500 heat map. On this side of the screen, we had a lot of red. On this side, we had a lot of green. So the breadth was good, but the big mega cap names took a little bit of a heater. Now, big pullbacks, they bring big opportunities. So in today's video of the Stock Market Brief Show, we're going to talk about some very important levels, expected moves, weekly, daily perspective. We're going to get into some seasonality stuff and much more to look for these opportunities that could potentially be here in the near future. We're going to get right into it today. Out of the 11 sectors, got quite a bit of them that were up. Real estate making a little bit of a comeback. Energy was hit hard, right? Now we're starting to see that bounce, get some relief there. We'll see here if we have any follow through whatsoever. Remember, it's tight correlation to oil, and oil does not look all too hot. We had utilities making a little bit of a comeback, and consumer staples relatively unchanged. The Dow Jones relatively unchanged on the day. S&P 500 was down about 0.5%. The Nasdaq was the one that got hit hard, and the Nasdaq 100 so hard that it started this parabolic SAR to uptick past the summation index, identifying a potential change in trend. Now remember, it does not mean that the market can't bounce back up and just go like this. Like that. It was very similar to right here, right? So the market, potential change in trend, went sideways, went down, and then we got another potential change in trend here, and kaboom, to the upside. The last real sell-off was right over here when we had that change in trend, and we went down, we flagged, and this is kind of where that volatility started contracting within this area before an explosive move. So a potential change in trend taking place in the Nasdaq Composite. The summation index on the New York Stock Exchange, another broad market, has not ticked over yet, but it looks like it's possibly going to be doing so here in the near future. So we'll see if there's somewhat of a comeback. Overall, in today's trading day, what took place? Well, as we finish down, you can see the week-to-date anchored VWAP, right? And these were the daily expected moves for the day, which on the SPY we did not tag, but we did close within. We remain below that 5-day moving average. You can see we try to get back above that daily VWAP, also the week-to-date anchored VWAP, and you can see it didn't quite get above it, and then it started selling off, trying to go for that lower daily expected move towards the end of trading day. And we're going to update these in today's show, so you're going to see the new levels and kind of some important aspects of what to watch for maybe going into the next trading session. The Qs got hit obviously hard. You can see that we started the day not too bad overall. We gapped down, but then we started pulling back up through, and we came into this prior area of resistance, also running into a declining 5-day moving average, which is something that we've been talking about to be aware of. If you were bullish, you want to recapture that level. Okay, we'll talk more about that later, but you can see here, then the sell-off really started to intensify, and it hung at the daily expected move pretty much all day, right? So we tagged it, we got outside of it, we come back and tag it, we pushed out, we came back in, we pushed out, we came back in, and then towards the end of the trading session, it was trying to get back above that month-to-date anchored VWAP, and it started pushing down beneath us. And you potentially look at this as a potential bear flag, opening the door to the lower weekly expected move, which we'll touch more on later. And you can see here also we closed below that month-to-date anchored VWAP. When we get into the daily charts, I'll kind of explain what that means. Now, where's the opportunities? Well, I want to just point out seasonality once again. Now, we've been talking about the seasonality chart, right? Down here are the trading days, right? So you have day 1, 2, 3, 4, 5, and so forth. We are going into day 18, the 18th trading day of June, and that starts where? That starts right here towards the bottom to potentially do what? Month-end markup, quarter-end markup. I can't tell you if that's going to be the case, but I will tell you that we talked about the run up here on pre-election year, and we talked about the difference when it made the split here versus last June and other years, right, that don't just include the pre-election years, which we're seeing in the dash. So we talked about the consolidation and the move up into around this area, and then we got that pullback. And now from a seasonality perspective, right, it's not perfect. We'll talk, like I said, we'll map out some key levels. But it is saying that, hey, this is where things start to turn around, not only from a pre-election year, but also it can turn around from all the other recent years that goes from 1950 to 2019 here. That's what the Almanac Trader chart put together there. It was kind of nice. I also want to call out that when we look at like day 18, where does that look like? Well, that's right here, right? This is the Qs, and where do we pull back into? We pulled back into that inclining 20-day moving average. So this is, as it stands right now, just a pullback. And we got to see now if strength can come back in to potentially mark us up into quarter end. If you take a look here, this is the Nasdaq pre-election year. You can see typically you get pulled back here into the June, but into July, you see one more, kind of strong move into the middle of the month, and then you're kind of stuck in a poor seasonality period from a pre-election standpoint, right? And even other cycles too there. But you can see we go up, we go down, we go up, and we kind of just chop around up until the end of the year. This is one of these tweets that I posted out a while ago. I think I've shared this on the Stock Market Brief Show too, but we were talking about a potential head and shoulders pattern and what that might look like if we get a full measured move. And that full measured move would take us to around 347.5 on the Qs. Well, this is kind of what it played out to be. We did pull down, we pulled back up, tagged that 5-day moving average. You can start to see it roll over. We came back up for it. Boom, we came back up for it. Then we started to sell off. So as it stands right now, when I look at this, like this would be a very dramatic move to come down to 348, especially during this period of seasonality. You don't want to rule that out as a possibility or not as a possibility. But I do want to call out that, hey, we do have this volume shelf down here, and we're pulling into prior area of resistance. Once it's broken, it can potentially become a level of support. And that's kind of around this 356 to 357 range where price is kind of pulling into right now. And once we get into the updated charts and show you the expected moves, that's where a potential opportunity could come into play. If we take a look at some macro stuff, right? This is the balance sheet, right? The Federal Reserve balance sheet, and you can see total assets. And this was right here, right? We started tapering, boom, started moving down, and then we saw this big spike up. This was during the banking crisis, and then you can see we're pretty much reverting all of that now, coming back down to where we originally were. Just this last week it updated and we kind of came out a little bit. So liquidity, a short way to look at this is, hey, liquidity is coming out. And there's a lot of different ways to look at liquidity. And I will call out, though, that when the banking crisis took place, they did start something called the Bank Term Funding Program, the BTFP. Okay, and you can see that started right here at that blue line, and that's actually coincidentally right where the S&P 500 started to really move higher. Now, I don't know if this correlation is going to hold, and I know this program is not going to be instated for, I think it was a year that it was supposed to be instated. Don't quote me there. But as you can see, it started, and then when this kicked on, the S&P 500, boom, relief rally. And you can see it chopped around a little bit here, right? They weren't using it, then it came back in, they weren't using it. This is what the S&P 500 was doing there and then. And then all of a sudden, boom, started using again, and woof, we went off to the races. And it is still being used. This last week, it actually upticked slightly. So that is going to be something interesting to continue to watch. Another form of, you can look at this as a form of liquidity is just other factors that are draining the reserve balances. And you can see the blue line, think of that as the liquidity, right? So, and it works with a pretty strong correlation. It started draining, the S&P 500 is the red line, it started going out, boom, it started going up, boom. And then they kind of had this tight correlation. And it wasn't until here we saw this kind of start draining, but the S&P 500 started ripping higher. That was during that NVIDIA, the AI really started to take off. But now what I want to just point out is just this last, like the prior week, it drained a little bit. And then this week, it drained even more. And you can see, well, the market's actually pulling back here slightly. So is the market waking up to liquidity being drained from multiple perspectives? Well, if we take a look at the Fed, the rate hike probability tool, you can see here coming into the July meeting, we are looking at raising 25 basis points to 525, 550. Right? We paused, or we what did he say? He's a potential pause. I forget the exact terms that he used, but we did not increase rates, and he's leaving it on the table that we still may do so. And the market is saying, yeah, it looks like we're going to be getting another 25 basis point and then holding it till this end of the year. So higher rates for longer is what the Fed has been saying, and the market is pricing that in as it stands this current moment. The next meeting is July 26th. So we still got some time to see what comes of that. Let's look at the S&P 500. We'll get down into some key levels. First one from a weekly perspective. Right, we haven't actually reconnected with the 5 weekly EMA for quite some time, and we're not too far off of it. So on the SPY, look at 430.12 as a potential reconnect, right? We got way outside of it, and now it's pulling back in, right? This is a very frequently tagged EMA, right? We pull outside of it, boom, we come back right in, okay? We get outside of it, we pull back in. You can see most weeks touch, and we didn't touch here, we didn't touch here, we didn't touch here. So there's going to be a week where we obviously reconnect with that 5-period exponential moving average. If we take a look at the daily time frame, you can see we pulled up into the high of the year, 443.90, and now we're starting to pull back, getting below the month-to-date anchored VWAP. So what does that tell us? It tells us, which is crazy to think, based off of the start of the month, because that's where we're anchoring it to, and this entire move, and now we're under this line, it's saying that the average buyer, all this right here, the average buyer based off of volume and time is now underwater. So to go and say, like, I mean, it's crazy to me that, you know, the month started here, we came all the way up here, there was a lot of volume traded. Now the average volume participant is now technically underwater. And that right there could be a very, you know, how would I say this? It could be a very psychological level when the average participant in a given period of time now all starts to feel pain. And if that pain intensifies, you can get obviously further sell-offs. Okay, people can dump their positions. Now, one thing that we want to pay attention for is if the month-to-date anchored VWAP starts to be recovered. Because if it gets recovered, people start to feel stronger. The average participant is back in the green. Perhaps they're feeling more confident and they want to add to this dip or this potential pullback. Now, if we're mapping out some key levels on the daily time frame, we did say that we potentially look for the August high as a potential area of support. Why? Well, resistance can turn into levels of support, right? We had resistance, 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 and now we're kind of coming in to test that area. If we get further sell side, the next level would be, it doesn't mean that that we'd come down here, but you can always look at a potential U-turn trade where price, kind of undercuts this level and then turns back up. But if we do start diving deeper, we had prior resistance here, obviously prior resistance here. We broke out support and then we started to take off. Never really tested that 420 level to 415 level all too much. And that's also where the current quarter to date anchored VWAP is. This quarter will be ending, but it is going to be a level that we want to pay attention to if we get a steeper pullback coming into next quarter. Okay, and even if we were to pull back into these areas, I want you to pay attention that, hey, we still have a series of higher lows and higher highs as it stands. Now, let's get into the 15-minute time frame. This is where we can get a little bit more tactical. Okay, so first, you can see that the week-to-date anchored VWAP were below. So the bears that got control of the week, they got control of the declining 5-day moving average. So if you are looking to be, more confident, getting bullish, you want this 5-day moving average to start to flatten out. You want price to get back above it, and you want this thing to start turning back up, and then you start buying the dips like so. Dips in really when there's strength thereafter. Now, this is the month to date. We're below the week to date. So going into tomorrow, if we get back above the week to date, that opens the door to come for obviously this higher upper daily expected move, and then also the 5-day moving average there. Now, beneath us is the lower daily expected move at 429. It's 429.04, but we'll just round up. And then the lower weekly is 427.84. So if we do get a stronger hit down into this area, say 429 or 427, as we previously stated, that would be just under the 5 EMA. So you don't want to close down there if you're bullish. But hey, if we undercut it, you always look for a potential back through trade or a U-turn trade or whatever you want to call it. It's all the same thing. We just rename it however we want. But that is what I will be paying attention to there. I would like to see a stronger move to the downside, obviously, because that would offer up a better risk to reward trade coming into a lower daily expected move or a lower weekly, because the statistical probability of closing within this is 68% of the time when you look at the S&P 500, and then also the weekly 68% of the time there too as well. So if we come down here or outside of it and we still have, a full week left, that could be pretty much the stall point. However, you got to understand, when we get below these levels and get kind of outside, pretty deep outside, dynamic hedging really can kick in. You can see volume start to increase, and then selling, piles onto more selling, and so forth. And that's where you can get some pretty strenuous sell side activity. If I pop into the Nasdaq 100, you can see we closed right down around the lows of the day. This is the weekly time frame, but the week just started. The EMA, it's still inclining at this current time, but it's at 356.38, so that's going to be another level to watch. If you just look over to the left, it kind of is in line with this prior high, and then this low. So in this area, this 355, 356 can be a potential level of support. You can see here we got disconnected, and now we're trying to go in for that reconnect, because it has been multiple weeks there without a connection of that weekly 5 EMA. So you can see here we're also below the month-to-date anchored VWAP on the daily time frame. We came into this prior area of resistance. So what you'd want to see, this is, to me, is actually healthy. It can become unhealthy, and it can become unhealthy quick. But what would be nice to see is more consolidation. And if that is the case, well, then you have a series of more higher lows, right? And matching highs or something like this where the pivot is. And then you start to look for a breakout, which can take us to 380, 400 potential all-time highs. Okay, so that would be something to watch out for. Below the week month to date, so look for the month to date anchored VWAP to get obviously recaptured, would be very important. But if we're looking at the 15-minute time frame, I want you to just pay attention to the lower daily expected move at 354.38 and the lower weekly expected move at 355.23. I personally would like to see price come down into this area come tomorrow, because then I'd start to be looking for a potential bounce play back up to the month to date, potentially back up to the week to date, potentially back up to the 5-day, potentially even higher, right? Because you got to understand, we pointed it out before, this is where you can potentially get month-end markups. So to see a little bit deeper of a pullback, flush out some more people, potentially scare it, what you could look for is a potential red to green day. So you get a big red day, and then all of a sudden people are getting scared, but then all of a sudden it turns into a green day and closes flat on the day. That would be a very good situation to potentially see follow through and get that month-end markup. That would be the opportunity that I'm kind of paying attention to. Now, if we don't get all the way down here, well, start to look to recapture the month-to-date anchored VWAP and then the week-to-date. Remember, it's still declining at this current time, so you want price to work itself up there, see what it does, and then eventually start to break back through that. And then we have the upper daily expected move at 360.98 there. I wanted to call out something I didn't call out, I don't think, on the SPY, but we do have positive divergences building in the RSI. So price action is obviously putting in lower lows, but the RSI is putting in some higher lows there. So it tells us as this is kind of flagging going down, this is starting to strengthen. And that could be giving us indication that we could potentially see it turn around. So that'd be a more bullish case there. But like I said, it also is taking place in the SPY as it stands. Now, if we get a big gap down, this thing could open up way down here. And then we might have a matching low divergence where this is much lower. So that'd still technically be somewhat of a positive divergence. So you just got to look at these key levels going forward. One last level that I wanted to talk about here on the Qs was obviously what we really quickly stated, but that was at 365. So another, as we started saying right here, this is going to be about 360. 360 is going to be a key level because price, you can see, got held up right in that area. So if we recapture that and price can move around like that or so, that would be a little bit more healthier in my opinion versus seeing a strong move right to 360. Boom. Like we saw that earlier today. Boom, strong move, but then it got completely and utterly faded. So just got to be careful, right? Got to be careful. We're going to look at some bonds and yields now. This isn't the greatest look, right? We touched on some macro data. The 10-year, 2-year is at now 93 basis points inverted. Just the other day, I think it closed 100 basis points inverted. And that's something that we haven't seen really since 1981, right? The very early 80s, okay? So this is not healthy by any means. And these are the best indicators of future recessions, and people are always going to tell you, this time's different, this time that, this time this, whatever the case is. Still, it's been it's 100% accurate, right? It's predicted every single recession when we get these inversions. And you can see the 10-year 3-month is now 178 basis points inverted. So these things continue to get steeper. One thing that I did notice, and I want to just point out here, is when the 10-year and 2-year yield curve inverted, what you notice is as it went steeper into inversion, the S&P 500 actually, it's not like it crashed or anything. It started actually moving up. And then when the yield curve started moving up, right, when it started trying to uninvert, that's when the market started to feel some pressure. You can see here it started inverting further. The SPY started bouncing up. Okay, then it started uninverting. Guess what? The S&P 500 started going down a little bit. Okay, it started going back down, getting deeper into inversion. SPY started going up. And then something interesting happened here where we saw a subtle move up, right? So there's a pretty strong move up. Actually, so it's kind of flat right here, kind of went up, right? This went down, this went up, this went a little bit down, then it started to drop. When it started to drop, this went up. But look at what happened here. We saw this big old spike, boom, okay? And then we saw this big decline right here in the SPY. So there's a pretty sharp move, right? Both from this perspective and a yield curve perspective, trying to get out of the being inverted. Then we kind of just went sideways to deeper inverted. And what happened? Well, the SPY has been just going up. Now I'm showing you this because that means just me, it's just a pretty tight correlation. If we start uninverting, well, that could be potentially bad for the S&P 500. And seeing as if we're already 90 basis points inverted, which, you know, we've only been there, you know, one time this year, and we haven't been this low really since the 80s, right? If this goes more into uninversion, yeah, maybe we can open up, go a little bit higher. And it's not always going to be perfectly correlated like that. But if this starts cranking up here, all right, the 10-year and 2-year, and we start to try to uninvert, perhaps there is more downside there in the S&P 500. And I don't have the big term chart, but a lot of the times what I've noticed here, when you go look at the big term charts, when it moves to uninverted and then the Fed starts dropping rates, that's where we actually started really running into problems in the markets, okay? If you take a look at the 10-year yield, still consolidating just under this lower trend line. This does look like it's curling over. So, hey, are we going to get some relief here? This thing going to come down. I tell you what, the 30-year mortgage tracks the 10-year pretty closely. And, you know, 30-year mortgage rates right now are pretty insanely high. I think they're around 6.5 to 7% right now, just above 6%. So still relatively high, and prices haven't came down all too much. So consumers, I would imagine, are going to feel that eventually here. If you take a look at TLT, right, I've been talking about us being in a potential stage 1. This is where bonds go up, stocks, commodities go down, the economy moves into contraction, and we enter into recession. You can see here, we're still kind of just going sideways. We just a low, a higher low, a higher low. We're back around all these moving averages, right? We're declining, starting to tighten up here. This price action going to eventually move up here in TLT. You can look at other proxies like SHY, IEF, and so forth. But as it stands now, we're just going sideways still in bonds. If we take one last look at a chart, it's going to be the dollar. The dollar was down today with the S&P 500. So if we're going to get month-end market, remember there's a strong negative correlation, meaning that if the dollar goes up, S&P 500 typically goes down, right? So dollar goes down, S&P 500 goes up. Well, the dollar was down today. S&P 500 was down too. So if the dollar is going to start backing off here a little bit, perhaps that correlation is going to kick back into play towards the end of the month, right? End of month and a quarter, and we start to see the market move back up. Remember, tops take a while, okay? And that's just to conclude it all. I'll reiterate what I mean by tops take a while. Typically, you know, tops, you know, it moves up, oh, then it comes down, people are scared, but then it comes right back up, right? Then it drops, oh, but then it comes right back up. So tops can take time, right? Tops typically do take time, like for example, this one right here too. So is this right here, boom, and then it's just going to come all the way down? That's always it's always a possibility. But just remember, don't be shocked if it comes boom right up to here. Now it doesn't mean boom puts in a higher low, right? That would be a higher low on a very shorter time frame. So you got to be open to these possibilities, right? The last time we were talking about it getting below the quarter to date was right here, and we said if it gets back above, that would be more bullish, and that would give you a good risk to reward trade to play it up. Well, we reclaimed that level. We saw it move up. If we reclaim the month to date, that at least opens the door to re-head higher, okay, to potentially retest this prior swing high. Okay, so that is what I'm kind of paying attention to. I'm looking at the daily expected moves. I'm looking at the weekly expected moves. That's all I got for you on today's show, everybody. Have a good night.